What's going on, everyone? My name is Nicholas Merton here from DataDash, and today is February 22nd of 2023. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, I'm here to say buckle up if you're investing in Bitcoin or stocks, because we're about to start heading lower. As we've started to face resistance at the 200-week moving average for Bitcoin, as well as resistance on a lot of our key stock indicators, with momentum signals flipping red to the downside, we need to start getting prepared for the worst case scenario here and start getting into a comfortable position where either we're taking profits on some of our long positions, or more specifically, remaining in cash and potentially looking at building short positions. We've got a lot of things to dive into in today's video, as well as a sponsored review of a really exciting protocol known as UNCX network. Now, for those of you who haven't heard about UNCX, they're a major infrastructure play in the crypto space, and they had a major rebranding. You might have known them previously as Unicrypt, that has built a whole range of different interesting technological solutions. So stay tuned for that later on. I think it's a really exciting play to keep an eye on, and let's go ahead and kick off the video. All right, I want to go ahead and start by talking about Bitcoin's price action here. As we've discussed, there is a multi-step process to formulating a long-term trend reversal, and that is not only getting above that 200-day and the 200-week moving average, but ideally on each step of the process, turning those indicators into support. And throughout the entire journey, we saw that. We saw Bitcoin getting up above that 200-day moving average, making it support clearly 2 times, with buy-side pressure coming off of those key moving averages for the first time during this bear market in a long period of time, to be actually able to get above that 200-day and really rally off of it. This really hasn't happened since November, and it's why a lot of people thought that the FTX collapse was the end-all be-all correction. That was the final low of the bear market, a lot of people have been thinking. Well, there's one additional step, which is to get above that 200-week and make it support. And unfortunately, as market makers know, and as they've been basically keeping the price around this range for the last couple days, they know the most FOMO, the most buy-side pressure comes in from people who don't wait for that last step. People who have been sitting on the sidelines, maybe even short the market, have been now so convinced as we cross above that 200-week that, oh my gosh, this is it. This is time to get long. And every time we wick right back up to that 200-week, you'll notice that there's a lot of retail sentiment chasing the trade that gets faded immediately. This is a typical distribution pattern, and it's a way where whales and large investors who propped up the move and bought at a much lower price can take advantage of the retail traders or the speculators who are chasing that trade, instead of just waiting for price to remain above the 200-week and find support there. People are already going ahead and chasing it. Where have we seen this before? It's exactly what happens, the same exact supply zone or resistance range that we found ourselves in back in August, just maybe slightly higher, to get people enticed, to get people excited, breaking above the price action in August, breaking slightly above that 200-week a couple times, and not being able to actually formulate support. But again, the investors aren't waiting for it, or the traders or speculators, they're not waiting for that 200-week support. They're going ahead and buying in right now. And that's the big mistake that everyone's making, because that is a liquidity trap. Classic 101 example of how market investors, or more specifically institutional investors, can trick retail traders and take advantage of that upward side pressure in order to serve as exit liquidity for positions. That's the name of the game. Again, we need to think about how institutional traders are thinking, not how retail investors are trading, because if we can understand how the institutions are going to utilize or take advantage of retail speculation, that is how we know where price is going. Now, again, as we talked about, I understand there's a lot of optimism heading through that 200-day. The price action definitely does look exciting, and it is nice to see price getting up to this range. But I think, as we've talked about on the channel, maybe we're not going to get our more lower price tag prices for Bitcoin, right? We may not go down below 5 digits. We may not go down to 10 to 12K. I'm totally fine to accept that, and maybe that we had focused on prices going a bit lower than expected. But at the same time, it doesn't mean that this can't be a long-term accumulation channel. Essentially speaking, that we're going to get retests back down in this range around 16K, much like we saw back in the bear market in 2014 and 2015. Notice how we went through a year of sideways chop and even set in new lows on the second flash sale on August 17th, 2015. I think that's very well what we're going through now. The crypto industry was going through a major restructuring at the time. Mt. Gox, or Magic the Gathering, had been hacked, and it meant a lot of Bitcoin and a lot of trust in the ecosystem was lost. This bear market is incredibly similar with Celsius, FTX, Voyager, Gemini, all of the major providers out there have basically led this industry to being in the same position it was in before. All the manipulation, the wash trading and NFTs, and all the just fake, hype and mania and the lies that were sold by so many projects. All of that is getting flushed out. Now, it takes a long time to build back that trust, to build new narratives, new things to get excited about, new value potential in the crypto space where there may actually be some really substantial and exciting things like Uniswap or other DeFi protocols that start to get built and people get excited. I can't tell you guys outside of some protocols that are maybe rethinking the way of doing DeFi, right? The existing trends in this space. I can't tell you guys of any new exciting trends yet. And I'm doing due diligence. I've got a ton of people in my network who are doing that research as well. And I can't find anything that's got me excited. It seems like people think we're going to get away. The people who are buying here think we're just going to get away with doing the exact same things we did over the last decade. New altcoins, new speculative theories. I got to tell you guys, in a non-QE environment, a lot of that stuff is not going to fly. When interest rates are at 5, potentially 6% over the next year, it ain't going to fly. It's not what's going to be going up. What's going to be going up are defensive plays, and more likely all assets are going to get hit during this environment. And that's why I want to spend some time here. Again, I know a lot of people are talking, China is now supporting this, this whole system of the two systems, one country, where essentially they're starting to become more of a crypto hub again, where Hong Kong is going to open up some vehicles for people in China or Hong Kong to have that retail exposure to Bitcoin. And this is, again, the China narrative. It is always like the used mechanism to spot bottoms and tops, or some similar story for that matter. It's always these kind of stories that are so vague. And I understand, yes, there were some comments and some draft legislations that are signaling that this might be, a cause to be a bit bullish or excited. But again, so what if retail investors can buy in Hong Kong? To be completely candid with you guys, if people wanted to get exposure, institutional investors, they already have exposure. Retail traders, which can definitely make a difference, likely have some exposure utilizing VPNs, utilizing other routes to exchanges like Upbit or other types of Korean exchanges. This has been going on for a long period of time. So again, I just want to emphasize that these are the kind of stories that get you to FOMO in. And they always come out right during these distribution periods because they need additional liquidity. Just don't doubt that there are people out there, because I understand the cost of like buying articles on, say, Cointelegraph or all these different platforms. I'm just going to put it this way. They have an easy financial incentive to buy up some articles or work with connections at these different publication platforms to get you to FOMO in. All right, all those large whales and participants, they know how to drive the narrative. So don't always chase the headlines. Rather focus in on price action, not just on Bitcoin, but in the macro environment. And let's take a look at our stock indices. Well, NASDAQ here topped out back on February 2nd and has been declining ever since. We got a red flip here on our momentum indicator that we utilize and you can get access to within the Dash report. And if you guys want to see how consistent this has been during the last 2 relief rallies, like the one back in March or the one back in August, when it flipped red, we continued downward. We deviated back below the 200-day moving average and we set in new bear market lows. Not a good sign. Not a good sign for the bulls. And again, if you're chasing Meta after gapping up 25%, or Amazon or all the big FANG stocks, and you think it's just going to be like it was over the last decade, well, think again. That's not how bear markets work. Market leaders from the previous bull market rarely ever lead the market once again, even if they may be cash-rich companies. Advertising revenues are getting crushed. Innovation at these companies is stagnant, outside of maybe companies like Meta that are making some big financial bets. What is Netflix going to do to grow the same way it's grown over the last decade? How is Amazon going to grow like it did over the last decade? How can Apple or Microsoft, all these companies continue to grow at the pace they were growing at before. Technology is great, but it has limitations. And because of that, we need to understand that the PE multiples these companies are trading at is not only going to be lower over time, but that their earnings are probably going down. We are stepping into a proper recession. The Fed is not easing up. The markets were wrong. The Fed is going to continue likely tightening at 25 basis points for the preceding months. The prediction markets are saying that, and on top of that, the Fed has been saying that. It's just that the markets chose not to listen to it. They chose to follow narratives of, oh, the Fed's going to readjust how it measures inflation, or the CPI more specifically, and that the Fed is going to tolerate 3% inflation instead. These are the kind of, unfortunately, just really petty narratives that have carried around. Take a look at the S&P 500. We've been going through kind of ascending channel here. Couldn't even come up to the upper part. On February 2nd, we topped out around 4,200 points on the dime. And since then, we had a major collapse downward from around 4,200 down to right under 4,000 points. And if we go below, we're already starting to deviate below the 200-day EMA. If we deviate below that 200-day and below this channel, you guys can pretty much bet that we're coming back down to that 200-week pocket. Same here with the NASDAQ. I think we're easily going to step below the 200-week, which is resting right here, right under where price is. And I think we're going to come back down, revisit this range, and possibly come down to 10,000 points. Dow Jones as well. This is really the scary chart for me personally, because these are supposed to be the defensive stocks that should be performing in a higher interest rate environment with high inflation, right? And still, these names have not set in a new high since back, or a relative high since back in November. Every single time topping out at a slightly lower range, not even deviating anymore, just rolling over. And now the momentum indicators have started to flip red once again. If we get below those 200-day moving averages, you're betting that you're likely going to be seeing prices go down, at least in the case of the Dow Jones, to 29,000 points, down to new lows. And I'm not saying at that point, you guys, we're going to see some major imminent collapse. I think you're going to need a catalyst for that. And who knows, maybe there will be something around them, but I at least know that there's going to be a chance where you can buy back at a discount. It's very likely you're going to get a retest around that range. Maybe not absolutely fresh new lows, but definitely not where it's going to be some dip here and then we're just going to rally higher. I don't feel like that's the case here. Take a look at the VIX as well. We emphasized this so many times, guys, on the channel. A lot of people were starting to feel, just because we deviated slightly, that, oh my gosh, this is finally breaking and that the VIX is going to continue to go down. Well, the VIX has been holding true for 5 years, more than 5 years, with an upward line of support. And we got a major bounce off of here since the start of February, from around 17 points to 22 points. And this looks like it's ready to start popping higher. Last time we did this, back in August 22nd, that was the start of the correction into September and October. This looks like we're repeating history to a large extent. And I'm not telling you guys you need to go all in short today. I'm not saying that it's just going to go in a straight line to the downside. There will be swings up to scare investors, to liquidate traders. There will be those kind of upswings to knock people off. But generally speaking, the trend looks very clear. All the signs are playing out. It looks like we're very well going in to chase back up here towards the 33-point range, which we usually have retested on the VIX. And another giveaway here is some of the indicators in the crypto space. Multiple weeks where Ethereum had been underperforming against Bitcoin, not a good sign. Really almost a month and a half now where Ethereum is underperformed against Bitcoin and has yet again signaled that this is likely a long-term distribution pattern for long-term Ethereum holders. Not a good sign. On top of that, total market cap, like we said before with Bitcoin, repeating history, deviating above that 200 week like we did back in August, and looking like it's about to go right back below it. If it does not hold on this 200 week and we get a big fat red candle here like we got back on August 19th, your bull market narrative pretty much collapses. We need to be able to hold that 200 week moving average. And until we can do that, which bear in mind, the 200 week is flatlined here. It should be very easy to do that. It's not upward, right? So we should be able to make support of this. If we can't, we're not ready yet. Now, last thing I want to talk about here is going back to the traditional markets. This was the biggest giveaway throughout the month of January and February. And we're probably one of the only few channels here on YouTube that we're talking about this, because most people don't track bond markets. And that is the US 2-year yield and the 30-year yield. Now, we've talked a lot about the yield curve inversion. That kind of helps visualize just how much of a potential dramatic recession we could have. But more specifically, overall, the bond market has been telling us that, it realizes the Fed is going to continue tightening. It has been telling us that in the US 2-year yield, where if we take a look over the last few days, has been continuously moving up to its highest level since back on November 8th, and the US 30-year yield is at its highest level since November 14th, continuing to track higher since the end of January. I'm going to keep asking that big question here, folks. Did you get caught in the liquidity trap? Did you let the FOMO get to you? I know many of you out there might be in that position, and I'm not here to say, I told you so, or to be snarky about it. I'm just here to try to emphasize why we don't chase relief rallies, and why, as we've emphasized before, over the last decade, right, we bought the dip on Bitcoin. If you take a look at the really long-term monthly chart, we understood that we were always having the Fed on our side and to buy when Bitcoin came to that 200-week moving average, right? We always emphasized buying the dips when no one, again, I'm not saying no one, but when most people didn't want to, right? You buy into that fear when you come down to that 200-week moving average. Why was that? Well, it's because the Fed was on our side. We could buy the dip knowing that they, rest assured, would provide the ample liquidity to support further upside. The Fed can no longer do QE, and it will not just be sitting on its hands doing nothing, it's actively engaging in quantitative tightening, and that is liquidity contraction. That is going to deplete the value of assets. It is going to benefit those who hold dollars in a bank account or hold treasury notes that are getting paid a really solid yield right now. Pretty difficult to justify buying equities, even those that pay a dividend, when we're entering into a recession where their corporate earnings decline, i.e. likely having their stock values decline. And on top of that, not only where people are paying a lower PE multiple, but to make matters worse, you've got bonds that are paying a guaranteed 5 to 6% yield over the next coming months. It's going to be more and more difficult for people to allocate capital to equities. So anyways, guys, I rambled on a good amount here. If you like this kind of rambling here, drop a like, consider subscribing if you guys haven't already, and let's go ahead and dive into this really exciting review around Unicrypt, which is building some really interesting infrastructure that could fix a lot of the problems that got us in the mess we are in the first place since back in 2021 and 2022. Alrighty, everyone. So in today's sponsored review, I want to spend some time to talk not only about a project that's been making some major waves here during the bear market, but on top of that has already built a whole range of tools and solutions used by dozens of projects within the crypto ecosystem that are not only allowing for streamlined deployment of tokens and new ideas, but also allow for added layers of transparency and removal of unnecessary trust. Two of which are things we desperately need in the crypto space following the 2022 bear market, and that is no other than Unicrypt Network. Now, for those of you who haven't heard about Unicrypt just yet, they're a company within the crypto space that have built a whole range of solutions already being used here today that are revenue generating and adding layers of transparency that are desperately needed in order to spring up the next bull market and value creation within the crypto space. Now, I'm going to go ahead today and talk about some of the big innovations, such as liquidity lockers, which allow for better transparency on new token launches and the liquidity that allows us to trade in and out of those assets. But on top of that, the UNCX staking program, or staking as a service, that allows for people to participate in the growth of Unicrypt's ecosystem in the long term. So we're going to be diving into these as we go throughout the video, but I want you guys to bear in mind that Unicrypt has been around the block here for a couple years, and they've had some serious traction in the meantime, launching a whole range of different services on a variety of networks like Binance Smart Chain, Ethereum, and Matic, as well as other EVM compatible chains, but also offering such a range of services such as liquidity lockers, token vesting, token minting, its decentralized launchpad, and farming as a service, as well as staking as a service. So as you can see, Unicrypt isn't pigeonholed into one specific thing. It is focused, on the other hand, on building a whole range of services that add real market value to crypto and have already been adopted by a wide range of projects. And one of my favorite things about Unicrypt being an infrastructure play in the crypto space is that a lot of the team is already well known, and the story behind the founding of the company is really interesting. Whereas a lot of projects go out there and raise millions of dollars on empty promises, the UNCX or Unicrypt ecosystem started off by just two individuals, James and Anthony, who are the co-founders of the project, and they started with no outside funding or investment, something I highly resonate with as it showcases the long-term incentive to build real valuable products that inevitably need to be revenue generating. So let's go ahead and start by diving into talking about liquidity lockers, because this has not only been the most adopted software from Unicrypt, but on top of that is probably the most valuable tool that was well overdue within the crypto ecosystem. So first off, before we talk about liquidity lockers, which might sound a bit overwhelming at the start, let's go ahead and try to understand first what liquidity providers are, LPs. Now, you've probably heard this term tossed around within the crypto space. If you ever utilized Uniswap, SushiSwap, or any type of decentralized exchange or decentralized exchange aggregator, you have benefited from liquidity providers. It is a means of providing the liquidity required for both sides of the pair. In this case, we're looking at a token pair between USDC and Ethereum in order to allow people to swap through automated market makers like Uniswap from one asset to another. So when you're a liquidity provider, you're providing an equal weight of tokens from each side of the trading pair in order to allow for there to essentially be liquidity for people to trade from one side to another. The more liquidity there is, the less slippage there is, and the more trading volume will likely be within the liquidity pool. So people are pooling their funds together in a liquidity pool or smart contract to allow for people to take one token to another and trade from one side to the other side of the trade. It's a really great service, and overall, liquidity provision and AMMs are the biggest use case of crypto. Not only is it exciting for the end user who wants to swap from one token to another, but on top of that, you can actually earn fees from the protocol that are paid to the liquidity providers from the end user. So this is a way where you're able to sit on two different types of assets and potentially make a return in the long term. Now, this is something that has existed here for a long period of time. And when you provide that liquidity position, you're essentially sending your ERC20 tokens, in this case USDC, and your core Ethereum tokens to the liquidity pool, and in exchange you get a LP token. This is effectively an IOU. It's a claim that at any time you can utilize to go out and withdraw your funds from the pool. And that should be a given. You should be able to withdraw those funds at any given time because they're your funds as an end user. However, when it comes to an overall project, or those who are incentivized to be long-term participants and should be rewarded for doing so, this is where liquidity lockers come into play. And they allow us to have better transparency for team tokens, for the tokens and the funds raised that are designated for providing liquidity and allowing for ample trading, and essentially can help, albeit never fully prevent, rug pulls within the crypto space. A big issue. Now, if you guys don't know this, we've talked about rug pulls on the channel before. It has been an over $2.9 billion issue last year alone. I don't even want to go into the full metrics for 2021, but I bet the team at Unicrypt will probably tell you it was probably even worse in 2021 as there was absurd amounts of money and speculation. And unfortunately, there are no things other than the negative incentives for this to persist within the space. So this is why we're starting to see Unicrypt's core technology lead towards a lot of TVL here. Even during a period of time when over the past year we've been in a bear market, the TVL that's been locked within Unicrypt has not only remained relatively strong, but we can see that there are over 23,000 liquidity lockers created and major traction going into the later part of 2022 and the start of 2023. It is very clear by now that this technology is needed and it can be very valuable. But how does it really work? And again, let's go ahead and talk about why this is something that could be very valuable for the crypto ecosystem. Well, let's go ahead and draw an example here. So we've got the liquidity provider. Let's say in this example, it's you. You have some Ethereum, you have some stable coins that you've converted from dollars into USDC. And now you want to be able to earn some fees on those two assets that you're just passively holding over time. Well, you can provide liquidity to a pool in Uniswap. And what's great about that is that, as we talked about before, you'll be given the LP tokens that will be brought back to you from the liquidity pool that serve as an IOU claim. But again, as an end user, this is a freedom that you should likely have, unless you're incentivized to provide that liquidity and are given some kind of farming yield for providing that liquidity long term that you're willing to take the risk on. But in the case of a token project, which has a team, might have investors, or people who have made it clear that they want to provide liquidity in order to allow for investors to feel confident and participate in the ecosystem, well, the problem is if they have the same freedom to do so, they could essentially commit a rug pull. So if they're able to withdraw that liquidity like you are, then it may be that at the end of the day, you're holding a bunch of tokens that are not going to have any real market value or liquid value where you can trade from one asset to another. This is just one of the major reasons why liquidity lockers are a big deal. Because essentially with liquidity lockers, in that example, the liquidity is not, so to speak, liquid. It is locked for a pronounced period of time, dependent on how the tokens are locked or the LP position is locked. So essentially, once those tokens have been provided to the liquidity pool, the tokens themselves, which act as the claim to withdraw them, are locked for a certain window of time. They are not available for the LP to go out and withdraw. Now again, in this example, imagine that this is the team or investors or certain participants who should have an incentive to provide long-term value, continue building utilities for the token, building within the ecosystem of that token. This already makes it very clear and transparent and verifiable on-chain that the team has a long-term incentive or a much better incentive to deliver on its promises, to continue building, and so that you as an investor will not only not be likely rug pulled, but on top of that, be able to have the ample liquidity guaranteed over a certain period of time where you can trade in and out and feel comfortable about having an investment in that position. So again, although there's no guarantee of anything, the liquidity provision locker will allow for the guarantee that there will be some amount of liquidity within the pool, the specified amount. Now, this is really exciting stuff. If you guys are interested to dive into some of the documentation about how you can participate with liquidity lockers, because an individual could do this, but also more importantly, it's about getting the projects that you like out there to learn about this technology, learn as to how it can benefit the trust and the lack of needed trust in the protocol, but on top of that as well, could boost value to the tokens, and it is a way that you can also earn income as you bring projects within the Unicrypt ecosystem. So the end users and investors in different types of projects would obviously benefit from this technology because there's guaranteed liquidity that allows them to trade in and out of their positions, ideally with low slippage, and guaranteeing at the end of the day that there's likely not going to be at least a lower likelihood of a rug pull. But on top of that as well, you're able to get a whole range of different referral income benefits from bringing people to the protocol. If you bring a project to the protocol, they'll not only get a 10% discount on the flat fee charge for liquidity lockers, but on top of that, you can earn up to over 0.01 ETH or 0.04 BNB for referring that project through your unique referral link. I highly recommend you guys check this out. It's a great way to not only make sure that the projects you're investing in are setting in high standards for their liquidity and making sure that you are going to be positioned in plays that have a better likelihood of succeeding long term, but on top of that, it's a way where you can make some really solid income from bringing projects to this better standard when it comes to providing liquidity. However, the big thing I want to emphasize here, and this is something that even the Unicrypt team is very candid about, it doesn't mean just because a project is using liquidity pool lockers or this liquidity locker technology that there can't be scams, that a project has strong fundamentals just because it uses liquidity lockers. It could be a failing project in the long run. It could be a project with negative intentions, and there are other ways where projects can still run away with the money essentially. So it is an improved technology overall for the crypto space, but it's not a guarantee of anything. Overall, it guarantees one key thing, which is that there will be liquidity for you to be able to trade in and out of a position. So long as the team uses things like the token vesting technology that Unicrypt offers, where you can see transparently that team members, investors have tokens that aren't going to be able to be just dumped on the overall AMM, such as Uniswap, through the liquidity pool, then if you have things like token vesting in play, you have the liquidity lockers in play, you can start to feel really confident that the projects that you're looking at that follow these and utilize these technologies likely have long-term ambitions. or at least are in the better pool of projects out there versus a lot of the noise and trash that just goes on in the crypto ecosystem. The UniCrypt team knows this better than anyone, and you guys know it here if you've been in the crypto space for some time. Having these additional layers of transparency can filter out a lot of the noise, and if a project is hesitant to use smart contract token vesting or utilize the liquidity locking tool for UniCrypt, that could be a big red flag that the project does not have long-term intentions, or at least isn't using some kind of similar software tools. However, UniCrypt is one of the best out there when it comes to these services, and they've been market leaders, as you can very clearly see through the rate of adoption. Now, I want to go ahead and, talking about that adoption, talk a little bit about how UniCrypt allows participants within the ecosystem to benefit from the overall growth and utility that UniCrypt offers as a project and company. So I want to go ahead and talk about the UNCX staking program within UniCrypt. Now, there are 3 different types of tiers, as UNCX is one of the native tokens for the UniCrypt network. There's another dual token, but I just want to go ahead and, for this context, focus on UNCX, which is the main protocol token. There are 3 different types of tiers where you can stake UNCX in order to benefit from the further rate of adoption in UniCrypt's products, getting yield in one of their 2 forms of native tokens. And what's really cool about this, and many of you are probably wondering, is, okay, if I stake UNCX, what's the benefit here, right? Why would I want to continue getting yield in UNCX? Well, because there's a built-in buyback program for the overall staking program. If you're interested in learning more about staking within UniCrypt, I highly recommend you guys check out the documentation, but more specifically, check into the UNCX staking updates, where they discuss some of the details around the buyback program. What's really cool, though, is that as you can see over time, the price has been moving up generally since we've been going through the bear market, outpacing the broader market here over the past couple of months. But more importantly, you can see on-chain verifiably the revenue that they're generating through their holdings in the form mainly of USDC across the Ethereum network and Binance Smart Chain, where they go through and purchase a large sum of UNCX with the revenue that they generate from facilitating these services. So it's really clear, it's transparent, and on top of that, one of the few projects out there in the crypto space, and it feels a bit crazy saying this, but after all these years, one of the few projects that's built not only valuable infrastructure within crypto that adds better transparency, but is generating revenue. That's very exciting to see. I really mean that, though. I mean, you can tell here there's no way to kind of beat around the bush here or paint it in a different picture. They're generating solid revenue here. And this has been able to provide a foundation where the UNCX token can benefit. So I highly recommend you guys take a look into it. And again, it's something where you have to choose on your own whether or not you want to participate in it. I'm not here to just tell you have to go out and do it. I want you guys to do your own due diligence, read through the documentation, take a look through some of UniCrypt's products, and more specifically, get hands-on with it. Try some of them. We may spend some time here on the channel in a future video talking about how you can utilize some of their varying different types of technologies. We talked about staking as a service today, as well as liquidity lockers, but they also have token minting, which allows you to streamline the launch of new tokens, and so many other services that could be of value to you. So for today's video, though, that's going to be it. So if you guys enjoyed it, drop a like, consider subscribing if you haven't already for exciting content like this here on the channel. And more importantly, go check out the links down below in the description as to how you can engage within the referral program, bringing on some of your favorite projects into a better standard of liquidity provision. And on top of that, check out some of the other services such as the UNCX staking program and so much more that UniCrypt has to offer. I really like where UniCrypt is going as a project. I think they've got a lot of potential, and I think the services that UniCrypt is building, the services they've already built, are going to be essential in order to see long-term adoption in crypto and to make sure we don't repeat the same mistakes that led us to the bear market we persisted through over the past year. That's it for today's video, everyone. Thank you all so much for watching, and I'll see you all in the next one. Take care, everyone.